Hi, I'm Steven Van Metre, and welcome to Macro Monday, where we talk macro and try to make sense of markets that, especially today, really just don't make any sense. I'm your host, Steven Van Metre, the prop comic of macro. Hey, look, if you can't have fun talking about macro, what can you do? Now, I want to talk about what's going on in the bond market. We were very, very close to getting a breakout last week. As some of you know, I'm kind of the self-appointed bond king, so we have to talk about bonds. And I want to talk today about why I don't think this is the week we're going to see it. And there's some really interesting data as we dig into how the hedge funds are positioned in the 30-year. And some of you probably already saw my comments on Twitter. And for those of you who don't know, I actually am now allowed to post on Twitter. And you can find me at Metre Steven, METRESTEVEN, linked in the description below. It's pronounced meter, but you'd never spell it right if you didn't know it was spelled wrong. Anyways, so on with that. Before we get into what's going on with the bond market, I want to answer some questions that came in over the comment section, which I think is kind of a better way perhaps for me to gauge questions so I could kind of make a show around them. So I was looking at the comments this weekend. I love them. Some of you are just absolutely fantastic. Great comments. And a recurring question that came up is, why do banks want lower interest rates when clearly higher rates are better for them from a profitability standpoint? And the question was, well, why, Steve, do you think that banks are trying to lower interest rates when it's not to their favor? Well, there's a number of reasons why. Probably the best reason, and I want, as we talk about this and think about how kind of smart this view is in terms of where the banks are positioned, right? So what have the banks been doing since 2016? They've been loading up on bonds, just a ton of them. And they've been increasing their reserves because they've got all these rules and regulations from the following the great financial crisis, that they just have to have these massive amounts of reserves. The problem is they still need more, and they're trying to get more. Well, wouldn't it be cool for them to, say, increase their reserves in a very short period of time by, say, 10 or 20%, maybe more, depending on when they bought these bonds? Wouldn't that be really smart? Well, how would you do that? Well, you would get the Fed to lower interest rates and drive bond prices higher. Wouldn't that be really sweet? Sure it would. And if you kind of think about, hey, that kind of does make a lot of sense, right? I mean, if I could just magically make my wallet fatter by 20%, that'd be pretty awesome. Or my brokerage account, because I don't keep cash in my wallet, so it getting bigger would not actually do anything for me. But that would be really cool. So how do the banks do it? Well, simple. They buy up all of these bonds. They tighten financial conditions to the point where the Fed, Powell goes, uncle, he's got his arm twisted behind his back, and he turns on the QE machine again, drives bond prices up because banks have the market cornered on them, and then the banks sell those bonds to the Fed through QE and get more in reserves, right? Because we know that QE is nothing more than a swap of reserves from a duration asset to an overnight asset of cash. Pretty smart, right? So if the banks can somehow leapfrog their reserves up, guess what that frees up more money to do? Lend. Interesting, right? So you can't do that going the other direction. The banks also make money on things like origination fees and other fees, not just on interest. So keep that in mind. Banks have been using other means to make money, knowing that rates are really low. How about to starve off defaults? Do you think that there's going to be a lot of people probably defaulting on loans coming forward? Sure. So how do you minimize that? Well, if you can get their payments down, maybe they have a better chance of making them. Well, lower interest rates is a solution to that. To spur demand, to get some of those people out that are not borrowing money to go borrow money? Absolutely. See, higher rates don't do that. Now, higher rates are better for banks. But think about it. Let's say that mortgage rates double from 3 to 6%. Do you think a lot of people would go out and borrow money to buy a house right now? No. You think a lot of people would refinance and maybe cash some equity out and pay down some other debt so they can free up their cash flow to spend? No. I mean, it doesn't make any sense. Again, long term, the banks do want higher rates. Short term, not going to happen. And the other problem is you think about financial conditions are tight. Now, how do we know that? The senior loan officer survey from last quarter was very evident of that. We had this massive QE bomb in March, and we've had 120 billion a month kind of as that tapered off. Financial conditions didn't loosen; they tightened because banks tightened their lending standards. And when we look at interest rates, have they really changed from March? Nope. It tells us that financial conditions are still as tight as they were, potentially even tighter. The dollar's the odd man out here. So, if you look at raising rates in a tight financial conditions, it's economic disaster. So hopefully that kind of answers your question. Now, we have one final one that came in, and I promised this person I would answer a question on the show, even though we're kind of moving away from that format where I want to take questions if there's enough around, if I see them in the comments, or if you don't comment, you can send me an email. If I get enough of them about a certain topic, I want to address it in the show. Now, this comes in from a really big trader. I think from what I found out, this guy's like a whale. When he pushes the trade button, it moves the market. So big shout out to I'm So Cool. His question is your theory. That's his screen name. He said I had permission to say it. So I'm So Cool. He says, Steve, your theory suggested the US dollar will go higher because of a global dollar shortage and various other reasons. Absolutely. That is what is going to happen. Just like it did during the great financial crisis, when everybody thought the dollar was headed to zero, like they always do, it doesn't work that way. So he says, my question is, why would DXY go suborbital, because it's going to, with swap lines wide open? That's a great question. I'm So Cool. So here's the answer to that. Think of the Fed as a pawn shop, right? Can you imagine, one of those famous TV shows, instead of going to the pawn shop in Las Vegas, you walk in the door and there's Fed Chair Powell. That's what the Fed really is. You think about it. What is a pawn shop? You take something of value, which I absolutely do not have anything of value in my office, so that's beside the point. You go to the pawn shop and what do you get? Dollars, right? Now, why do people pawn things? Because they need money. It's a simple reason, right? Nobody would pawn something if they didn't need money because they have no other way of getting it. And they take that money and they go solve their problem. But what happens to be the second problem? They still don't have the money, right? If I'm short on rent and I pawn something of value to get dollars to pay my rent, guess what's going to come up next time? Well, I got my next month's rent in the future, plus I've got interest on my loan to the pawn shop to get my stuff back. All the Fed is a pawn shop for dollars. So someone comes in with a Treasury security or a mortgage-backed security or whatever the Fed's taking in on trade that day. Granted, the interest rate's probably pretty small compared to your traditional pawn shop, and you get some dollars. And that immediately alleviates a problem. But it doesn't lead to the creation of dollars. It just solves a dollar problem for a short while until the next payment is due. And ultimately, that's where we get dollar shortages from, because there's more loans than there is money to service them. If I'm pawning things to the Fed, my Treasury securities and mortgage-backed securities, to get dollars as a bank to provide to my customers who need dollars because they're short and need to make on their loans, they still need to get dollars in the end. And the swap line doesn't create them. It just temporarily alleviates the problem. Because we can't do swap lines in perpetuity. That wouldn't make any sense. So the dollar shortage does not go away due to swap lines. It's just an indication that, bad things are coming because now all of a sudden the pawn shop of the Fed is now open. Hope that helps you out. I'm So Cool. It's pretty warm here, so if it's okay with you, I'm so hot. All right, let's move on to, like I said, you can't have fun doing macro, then what else can you do? It is a pretty dry subject, let's be honest with ourselves. All right, what's going on in the bond market this week? Because we're really close to seeing this breakout. Last week, we looked at the charts, it's like, it's about to break out. And then we saw some pretty heavy selling come in there. This is probably not the week that I expect to see a breakout. Why is that? Well, let me show you what's coming up in the auction schedule. And you can see, I'm going to go through it. I want you to think, from a big picture, why someone who is betting against the Treasury bond market, right? Your Treasury bearish, yield bullish. See here, this is you. Why would you, if your betting yields were going higher, be excited about this week's Treasury auctions? Let's take a look. Now, where do you find this data? You can go to treasurydirect.com. Under announcement and results and press releases, you have today's auction results. And you can go and look at what's coming for the week. Now, there's a 3, 10, and 30-year this week. So let's go and look at the 3-year from last month. $46 billion in offering. Now let's see what's coming this week. $48 billion. If you can't read it, I'm just going to tell you what it's $48 billion. So a slightly bigger 3-year auction. Now, what's notable about the 3-year auction, not a lot of demand here. I mean, we've seen these shorter-term Treasury auctions not see a lot of demand. I'm not expecting there to be a lot of demand this time, but guess what portion of the bond market the Fed's buying the most of? The shorter duration. They're buying anything over 1-year maturity, no T-bills, and any note or bond over the 1 year or more to maturity. So they're soaking up a larger portion of these shorter term notes. Now let's go and look at the bonds. So here's where I want you to be thinking. Last month, I think this was a record, $29 billion in offering on the 10-year. On Wednesday, $38 billion offer, $9 billion more than last. Now you go, okay, you're trying to figure it out? Do you know what speculators and everyone else who's betting against the bond market are hoping for? A big failure on the 10-year. They're hoping there is weak demand and no one's interested in buying that much debt. That's what they're hoping for. It almost doesn't matter because we've talked about before, the Fed is kind of mopping up excess supply at the long end of the curve. So even if this auction isn't stellar, and the last one was, it was like huge. I mean, foreign investors, I think, took 70% of the auction or something. It was a lot of demand for long paper. Now, why are these auctions being bumped up? Because the Fed or the U.S. Treasury is letting T-bills roll off the supply. So some of these T-bills mature, they're pushing them into longer maturity debt. So that's why we're seeing these bigger auctions. And now you get why people are hoping and betting, and why I expect, at least going into Wednesday, perhaps Thursday, we're going to see downward pressure on Treasury bonds. Now, it doesn't mean it's going to break down to the bottom and fall to the floor. No, it just means I expect to see some positioning as such. Let's go look at the 30-year on Thursday. Last month it was $19 billion in offer and go to $26 billion. So that's a big increase of $5 billion. And its offering amount too. Now, what's interesting about that, if we go look at this from a chart perspective, here is 30-year Treasury yields, and they're sitting right in what is very clearly a topping pattern on a 90-day chart, and you can see it closed just over 1.25 today, slightly. So sellers are right here in this zone between these two purple lines. They're very strong here, selling. So no surprise that earlier last week that they were aggressive at selling this up. They knew what was coming, and they're hoping these auctions are a massive failure, that no one's going to show up and bid, and all of a sudden, that's going to make rates go up. Don't think that's actually going to happen for a minute. Because if we go and look at how speculators are positioned in the futures market, this is fantastic. So 10-year notes, they're actually long a little bit, and they've been slowly increasing their long position. Not enough to say there's a bottom end. They're inching their way up. But look at the 30-year. This is really where I got excited this weekend, because when I saw this on Saturday morning, man, I was like, it's like Christmas Saturday morning. Largest, and I know some of you are going to say, well, how do you know this is only a chart from 2016? It is. It is the largest net speculative short position in the 30-year bond in history. It just is. You'll have to believe me. It is indeed that. And when I see that, you know what I'm thinking? That's right. You know what's coming. The crown has to go on because, hey, when you have the largest speculative short position in the bond market, the auction's not going to matter. Everybody's got their chips. They've already placed their bets. You know, sellers can only get so much juice out of this thing before it doesn't go anywhere. So I don't worry about this chart at all. It doesn't bother me. Maybe it goes up a little more by the end of the week, but we're still in a massive topping pattern. And in fact, if anything, I was looking today, we saw some gap closures. Now, there are some gaps up in here that aren't filled, but now all of these gaps right in this range have been filled. So it'll be interesting to see how this week plays out. If we look at TLT, the mirror opposite of that, let's zoom in a little bit to the 10-day. Remember, we were looking at these two consolidation zones, the dotted in between the dotted purple lines and the cayenne lines, and no surprise, I thought, this morning, even though it was trading up here early, I thought, I bet you it gets down to this bottom dotted purple line and just hangs out there. And sure enough, sellers are getting set up because they're hoping to break this structure up here via the auction. They're hoping all of this comes out. We'll see. It doesn't seem very likely given the fact that the Fed, large commercial banks, and foreign investors have been buying massive amounts of treasuries. Let's go back to the hedge fund positioning, and we'll kind of wrap up after this. Take a look at the dollar. West Texas Intermediate, no real change there. Everybody's still betting on inflation. Speculators, no real change on their S&P 500 shorts. Look at the euro. You want a case why the dollar could go up? Largest speculative net positioning long positioning in the euro. That's a sign that people are overcommitted to one side. That's why this 30-year chart is so exciting, because you have just an overposition. The market is completely lopsided from a speculative standpoint. Let's take a look at what else we have. Gold futures, no real change there. Again, dollar rally. I think dollar rallies, gold's going to get unwound. NASDAQ, slight decrease in the net longs. Small caps, slight decrease in the net longs as small caps just seem to be on a tear lately. And US dollar, still no change really in the net shorts. This is looking ripe for reversal. We'll look at the dollar chart in a second here. And then the VIX futures, no real change there. Let's take a look at the dollar, and we'll call this a show. And here you see the dollar, one bottom, two bottom, an overnight bottom, and now it's starting to rally up in between these two purple lines, which is a major supply zone that's going all the way back to 2015. If the dollar holds up here, it's going to make a move higher, and the market is not expecting that. But of course, we know it should. Why? Well, because there so happens to be a correlation between, or relationship between, long-term treasury bonds and dollars. And one's going to be right or wrong. So either yields are going to go up to catch up to, so bond prices can catch down to the dollar, which is what the market is heavily betting on, or dollar bullish. Bond king, also dollar bullish. I'm Steve Van Metre. Thanks for taking the time to watch. We'll see you Wednesday. We'll kind of be curious to see how those auction results come out. We'll talk about that then. Take a look at the bond market and all kinds of whatever other economic data is between now and then. Thanks for watching. I'll see you then. Bye now. The content of this video is provides educational information only. It's not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation by or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that I'm going to do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.